Kirk, 25K in sight on the Dow, north of 2,700 yesterday on the S&P 500. Is there any relevance if we print 25K today? Does 25 mean anything to you?
Not particularly, but look, this is a great market, and as we talked about earlier, it's going to continue. I don't see any reason why it shouldn't slow down, but I think it's reasonable to expect that this year is up 5 to 10%, but not 25.
Mark Yusko, the relevance of 25K to you if we snap that and close there today?
I agree with Kirk. Just no relevance at all. It's just another round number. Everyone's going to put a big number or big attention to it, but it's just a number.
Mark, we seem to be entering a phase where I would say the bull market is less unloved than it otherwise was in the years gone by. Do you sense that too? And do you see more participation coming into this market, more retail participation, more people buying into what you might call the latter stage of a bull market?
Yeah, I think it's kind of funny. It's just been called the most hated bull market for a long time, and I just think that's bunk. Mutual funds have their lowest cash holdings since 2000. Individuals have their highest weighting in financial assets relative to income that they've ever had in their history. Triple levered short ETFs, there's almost no interest, no one owns any. So everybody's all in this market. I call it the all-in market. And I think what's interesting is you can see that in the fact that earnings have gone up a little bit, but not that much, but the multiple keeps expanding. So we keep paying more for every dollar of earnings, and I think that's very dangerous.
Kirk, do you see a market where everyone's all in, a cash level is being depleted to that extent?
I think people are all in, but institutionally people are rotating into the markets that trailed last year. Things like dividend yield, low volatility, global long-short products. So I think everyone is thinking about, they want to in some ways hedge their equity, stay exposed, but hedge it. And they're also worried about rising interest rates. So they're trying to figure out, how can I reduce my equity exposure but stay involved and also hedge against rising rates?